Capital discipline has become essential as founders face tighter funding, cautious investors, and higher expectations. The old growth at all costs model no longer works when capital access becomes more selective and expensive. Startups now need evidence that every dollar spent creates learning, efficiency, or durable enterprise value. Growth still matters, but growth without economic logic creates fragility instead of long-term competitive strength. Investors are examining customer acquisition cost, lifetime value, payback periods, margins, and burn multiples closely. Capital-efficient companies gain flexibility because they rely less on constant fundraising to keep operating effectively. That flexibility allows founders to choose better investors, extend runway, and survive difficult market cycles. Strong companies treat capital as a scarce resource, even when they have money available today. They focus on product quality, customer retention, disciplined hiring, and repeatable revenue before aggressive expansion. Premature scaling remains dangerous because it often hides weak retention, poor pricing, and operational gaps. Hiring too early, entering new markets, or launching new products can create expensive complexity quickly. Unit economics determine whether growth creates value or merely consumes investor capital to buy revenue. Founders must understand CAC, LTV, churn, gross margin, expansion revenue, and cash burn continuously. Every major spending decision should be compared against alternative uses of the same limited capital. Sustainable startups prove that customers will pay, stay, expand, and support profitable growth over time. Capital discipline is not about thinking small, it is about building intelligently with measurable outcomes. In 2026, resilient venture builders will turn disciplined capital allocation into lasting strategic advantage.